right, last week the global banking world was rocked when stocks of Credit Suisse, the 167-year-old institution, fell to record lows, creating panic. The world over, the situation led to many wondering if we're seeing the start of a collapse similar to the one in 2008. There has been a saving grace so far. UBS, Switzerland's largest bank and Credit Suisse's rival, has inked a historic deal to acquire Credit Suisse for $3.25 billion with the backing of the Swiss government. Though the deal is hopefully going to calm global markets and pacify edgy investors, what have the events over the past weeks taught us? We've seen that Indian markets were definitely not calm or pacified today. The question is, why have we seen 3 banks collapse, go belly up in just about 10 days? Agreed that there are different situations. There are 2 banks in the United States, Silicon Valley Bank and Signature, which went belly up for very different reasons as compared to Credit Suisse. But it also has raised very, very serious questions about both the Fed's actions, the consistent interest rate hikes by central banks, as well as what is ailing the world's banks. Before we move ahead, let me go across to my colleague Lisa, who's explaining why the next few days is very crucial. There's a meeting at the Federal Reserve this week, and it's become more important than ever.
Well, the Fed FOMC meet is expected tomorrow, and it will go on till Wednesday, where the outcome of the rate hike decision is likely. Well, this is the first meeting since the SVB and Signature Bank crisis, and also the first meeting since the Credit Suisse as well as the UBS deal. Well, the question that arises is whether the rate hikes have reached the crucial inflection point. Just last week, the European Central Bank, they stuck by its inflation fighting spirit by hiking its key interest rate hike by 35 bips points. Well, this time for the FOMC meet, the consensus is not very clear because there is uncertainty regarding this time's FOMC policy on account of the banking issues. Just 2 weeks ago, the debate was around whether the rate hike would be between 25 bips to 50 bips at the March meeting. However, expectations are now rife that there will be a 25 bips rate hike, or there might be even a pause at the meeting. So the key commentary to watch out would be whether Fed would prioritize its fight against inflation or whether it would focus on maintaining the financial system, whether there would be a contingent impact on any other banks, and most importantly, whether this would mark a pause in the rate hikes.
All right, to speak more on this, Rahul Bajoria, Chief India Economist, Barclays Capital, is with me on the show. Ashvin Parekh, Managing Partner, Ashvin Parekh Advisory Services, and Ajay Bagga, Chairman of Elements Platforms and Market Expert, with us today. Welcome to all of you, and thank you so much for speaking with us as we try to make sense of what's really going on. Now, let me begin with you, Mr. Bagga. One would have hoped that this, as I call it, the shotgun wedding of UBS and Credit Suisse would have been enough to calm investors. After all, there have been 3 spots of trouble, but then very quick responses as well from regulators, from those specific governments. Why is that not enough?
Tamanna, over 2 weekends, we have seen 2 different bankruptcies happening. Last week, it was Silicon Valley and Signature Bank in the US, and then this weekend was Credit Suisse with a forced merger. So one is that there's a recurrence of the problem. So and banking is running on confidence. So customers are really thinking, what else are we missing out? Which will be the next shoe to fall? And how bad is the situation? Is there a risk of contagion as happened in 2008? So that is what is upending the markets. The second big thing is this is end of the Volcker era of 40 years of low rates and stable growth, low inflation. We are moving into a different era totally of high inflation, higher rates. And the banks were clearly not ready for it. Very low rates made them take much more risk than was warranted. And now that risk is coming home to roost. The third is just the sheer magnitude, Tamanna. If you see, as of December, FDIC is talking of US banks holding $620 billion of unrealized losses on their bond portfolios. They can hold it to maturity. That's allowed by accounting. But in case deposits run out, then they have to sell these bonds. Now, today, the numbers for Signature Bank came out. Out of $98 billion of deposits, they lost $60 billion of deposits in the last 2 weeks. They were down to 38 billion. Now, to create a liquidity of 60 billion, no bank has that kind of liquidity. And if you go to sell the bonds, you have to crystallize the losses. Now, to put it in, some kind of sizing, 620 billion is versus a 260 billion total profit of all US banks put together in 2022. And this 620 billion is a disputed number. Five university professors took out another report on March 13th where they said this is nearer to $2 trillion. So just the sheer scale of these unrecognized, unrealized losses is making the market very wary. And fourth is what customers are asking. Is there a problem if I move from a smaller bank to a larger bank to safety, or if I go into a money market fund or buy a government treasury directly? And the answer is no, there is no problem. Go for safety. And that's what's happening. 200 US banks are facing a flight of deposits. Just over the weekend, they wrote to the government asking for a 2-year deposit guarantee to help them cope with this customer exits from the gates. So it is still an evolving situation. We have had some stoppers put by the governments and the regulators, but the situation remains grim.
So that's the problem. Even though you've had quick responses and an attempt to sort of stem the wounds, band-aid the wounds, the fear is that it will only grow. Rahul Bajoria, what is your biggest reading into what we're seeing right now? It's actually history unfolding in the last 2 weeks. You know, in hindsight, we'll be talking about this for years. The day a 166-year-old institution just collapsed on itself and got bought out. I want to talk specifically about Credit Suisse for a bit because there are two different stories in what's happening in the American banks and with Credit Suisse. In Credit Suisse, is it a lot of bad action catching up, or is it just bad timing? Even this, material concern statement, the Saudi National Bank statement might have not made people so jittery if over in America, banks weren't collapsing.
Yeah, no, absolutely. I think there is, as Mr. Bagga said, there's a crisis of confidence, and it's been a confluence of events. Whether deterministic or more opportunistic, we don't know how exactly it plays out. But certainly at this point, I think the nervousness, particularly in the credit markets, and also I would say policymakers, who are not really seeing any significant amount of weakness in real sector, right? At least as far as if you look at labor indicators are concerned, if you look at even the credit or FX markets are concerned, they're not really showing a lot of signs of nervousness. And so naturally, they are also confused about to what extent do you want to support, at a time when you are also worried about tackling inflation. And so I think that kind of creates almost a perfect storm as far as markets are concerned. And I think at this particular point, as Mr. Bagga said, banking is all about confidence in the institution and its ability to service the liability side of the balance sheet. And that clearly is becoming a little bit of a concern. I think what perhaps is a little bit of a saving grace is that we have seen swift action, both in terms of injection of liquidity and also in terms of, steps to kind of reshore the banking system. But I guess till the time, things kind of stabilize and we see some more incremental data, which indicates that there is actually not a lot of tightening of credit market conditions. I think till that time, there will be nervousness about both the impact of the solvency and liquidity of a lot of institutions, but also its incremental and eventual spillover into the real economy.
That's the thing. We're seeing panic in the markets, but it's not just investors losing money. Today, Credit Suisse's 81 bondholders will also lose money. And the concern is that it will spread and into the real economy, as the real world, as Rahul Bajoria says. Of course, equity investors and their money also matters. Ashvin Parekh, is this just a confluence of bad timing, or is this a series of bad actions coming home to roost, especially in the case of Credit Suisse? You have scandals galore, laundering drug money, spying on ex-colleagues. I mean, it's reading like a script for a movie. And Credit Suisse has gotten away with it all of this time. So is it just bad practices catching up?
Yeah, it's a bit of both. I suppose in case of the US banking, perhaps it could be timing. But in case of Credit Suisse, one can clearly say that there are bad decisions, quite clearly. See, what seems to have happened is that just 2 years, before or during this period, there has been a lot of credit flow. I mean, there has been a lot of liquidity flow into the system. The valuations were totally at a different level. And in fact, the investment banking decisions made by two particular funds of Credit Suisse were particularly bad. So I mean, you could realize, and the signs were there. There were clear number of indications available, suggesting that there was a huge amount of weakness in the balance sheet itself. So there were signs. So the timing is particularly relevant, I suppose, in case of the U.S. banking, because it seems to have happened all at the same time. I mean, two banks, and then the confidence of the deposit holders may get a little sort of shaken up. But Credit Suisse has, been a different example altogether. I think the swiftness with which the central bank worked on it and then brokered a deal is something which is really interesting to note. It should restore some amount of confidence to my mind, but then, of course, one is to see how much of liquidity will be required for depositors. If there is a run on deposits, for instance, then how much of that liquidity UBS will be able to manage within this period is certainly a matter of detail. Just a quick one. My mind just goes back to something that happened during the global financial crisis. If you really go back into the history, say Merrill Lynch, for example, was eventually picked up by Bank of America. And then we realized that the kind of valuation that once again, the kind of loss to valuation, on account of the valuation changes or differences, Bank of America could realize a good amount of that back, in just about 2 to 3 years' time. So something like that may pan out. There's a confidence issue at the moment, but I suppose the underlying values may come back after a little while. So,
To get a word on this confidence issue, to the outsider, it might seem astonishing that an entire banking system can unravel so quickly with a trigger as simple as one investor saying no, absolutely not. I'm going to come to Ajay Bagga on this because we were speaking about this last week, that the way the Saudi National Bank representative said that, the way he said it actually spooked everyone. And someone in my office was asking this question today, that is the global banking system so fragile? Where do we put all of our money? And it's a very layman question, but it's a serious one.
Yeah. No, the best way to run banking is the old way of relationship management and very stodgy banking. But what happened with these low yields, Tamanna, right from 2008 onwards, as the money was flooding into the financial markets, the banks were also searching for yield, and they took on more risk than was required. If you look at, say, a Silicon Valley bank, their return on assets was a return on equity was something like 16%. They were doing very well, and they had only lent 44% as loans. Rest was in US government bonds and US agency guaranteed mortgages. It was not 2008 solvency. What Rahul ji said clearly, it was more a liquidity issue, not solvency. But the liquidity then transforms into solvency down the road. So was it a fragile situation? Yes, it was. And what was the match that lit up this tender? It was basically the rates rising, and they kept rising till it reached a breaking point all of a sudden, and that's how crisis come, Tamanna. We saw that in 2008. Everyone was very confident after Bear Stearns happened. Oh, it won't affect, and we'll be able to manage it. So much so that the US government let Lehman fail. Then they saw the huge cuts coming in the markets. The markets just seized up. No one was ready to trade. And that's what happened to Credit Suisse over the last 2 weeks. Counterparties just stopped using Credit Suisse as a counterparty. They were not sure whether it would survive over the weekend. And the Swiss government went into this weekend with three options: either force UBS, the largest Swiss bank, to acquire it; second, nationalize it so the Swiss taxpayer comes in, which having done that in 2008 to UBS, that was not very palatable to the government. Or third, let Credit Suisse fail, which on a 600 billion balance sheet bank, it would have brought down the global system. So that is the risk that the Swiss government went in with. It's not a very elegant solution. It was the best solution. It leaves a lot of issues. One, as you mentioned, shareholders getting totally whacked out of shape, especially the Saudi National Bank. They invested in October $1.5 billion, and they've taken more than $1 billion haircut on that investment. Now they are giving brave statements that it's 0.5% of our asset base. It might be true, and it's good they're able to absorb this loss. Second is the 81 bonds, which you mentioned. Now, 81 bonds we saw in India also with one private sector bank. Normally, they come after the equity holders have been wiped out. Here, the equity holders walked off with some value at least 3 billion francs they walked out with, $3.25 billion dollars. But the 81 holders were totally extinguished. That is a $275 billion market in Europe for 81 bonds. And that's why the three European regulators were very swift today to point out that as per our agreements, equity will go first, then the 81 bonds. It's not direct that you can extinguish. So that's the difference from the Swiss government. Third, the minority shareholders were not given any rights. See, there are no promoters for these banks. The West Asians owned about 20%. Largest was Saudi National at 9.9. But there is no promoter as such. It's management and board-driven banks, and as largely in the West, the minority shareholders were not allowed any chance. So they passed an ordinance that in the larger good we are doing this. That leaves people very skeptical. And that's the fourth thing I would like to raise. There is a re-rating of the banking sector that happened with Credit Suisse, because now you don't know how safe your equity is. You don't know how safe your bond lending into the bank is. Based on that, why won't you go for a FMCG? If you want growth, why won't you go into technology? At least a bad management, you will not get your equity extinguished. You will have some chance of recovery, unlike what's happening with this. So that crisis of confidence, not only to depositors, but also to investors, Tamanna, what Mr. Bajoria mentioned, I would totally endorse that. That is the bigger thing, and that you can't build overnight. It gets built over years, and it will take quite some time. And that makes the situation very fragile. For any other misstep, it could lead to more problem, and that's how contagions then happen.
You know, Rahul Bajoria, the crisis of confidence is really the big question. How do you reverse something like that? And in your view, have we seen the worst behind us? Do you think that this sort of crisis will not turn into a contagion, looking at how speedy the action has been?
So I think it's going to be an iterative process. Ultimately, we are in a very fast evolving situation where market conditions, market sentiment is turning very rapidly. We have seen that play out in the US Treasury bond market. We have, to a certain extent, seen that play out even in the credit markets, specifically in certain names. So I think one thing, which we can be rest assured of is that policymakers, central bankers are keeping their eyes and ears open. And, as the ramifications and the implications, as Mr. Bagga outlined, of this particular decision sort of unfolds in various markets, you will see a reaction function, which will be kind of geared towards making sure that people, feel comfortable holding risk, both from an institutional and from a sectoral perspective, right? I think that will be kind of the underlying objective. But yeah, we are in a period where I think people are interpreting the implications, both short term and long term, of the actions that have been taken and its impact in certain markets, particularly say the 81 markets, which people are still kind of thinking through what the longer term implications are given the actions that have unfolded.
Ashvin Parekh, what do you think is the biggest takeaway and the lesson of this crisis, assuming that, it's the right time for a post-mortem? We don't know if we're in the middle of it or at the end of it, but what is your biggest takeaway so far?
Well, I mean, the way I would look at it is, you see, I'll tell you, I think banking kind of arrangement or banking system, will play out based on the underlying that it possesses, basically. Now, I mean, in some of the cases, for instance, let's say if you're looking at some of the Asian banks, for instance, I mean, the kind of regulatory intervention is very high. So therefore, I mean, at least the banking system, let's say in some parts of the world, I mean, on a global scale, are at least protected. I mean, that's the way I'm looking at it. From the, as far as the aspect of confidence is concerned, it's a matter of time, quite clearly. I don't think there is a ready answer for something like this. But one thing which is very remarkable, I suppose, compared to the global financial crisis is, I suppose the regulators have become far more active, far more proactive, in fact, in regards containing the risk, and then making sure that the confidence is somehow restored. So to that extent, I mean, I would certainly say that we'll have to wait for a little while. But one lesson that I'm learning quite clearly is that I suppose the banking kind of, which is more closely watched by the regulators all the while. I mean, let's take Credit Suisse as an example. There were signs, basically. There were real clear signs, but I mean, the regulator should have got more active just a few months before, as soon as the 21-22 report came out. The regulator should have really started acting from that. But I mean, so these are different markets, these are different conditions. But I still believe that the kind of regulatory intervention that is there now and the understanding of the banking system is far more than what we have. That gives me some amount of confidence, that at least, I mean, after a certain period, once again, the confidence may still be restored.
Let's hope the confidence is restored sooner rather than later. 2 very tumultuous weeks. We'll have to wait and watch what happens next. And as of now, at least feel some security in the fact that the Indian banking system is still robust and doing well. Thank you so much to all of you for joining us.